Joining me today, I will cover Athabasca Oil Corporation corporate slides for July 2025 and just kind of see what's going on there and cover the basically the dynamics and what's taking place at Athabasca. Hopefully you enjoy it. Let me know in the comments if you like that talk and kind of go from there. So for me, and again, not investment advice. Please see the first slide that I put there. That for me, I really like this company. It's an intriguing company. I've been following it for years. The concept of kind of not having net cash basically on the books really positions them well. And let's kind of revisit exactly what's going on. You can see here in this comment here, pristine balance sheet with net cash position. So that's really unique to this company. And the fact that they're not paying dividends and buying back shares is also something I really like, because as they kind of grow production and reduce the share count, people get that incremental value. So low decline, high quality thermal assets with 90 years of reserve life, self-funded growth in high quality Kaybob Duvernay oil play. So that's kind of the entity they have that it's not really like free cash flowing. It's basically they're taking the money and reinvesting into the business, while the thermal oil assets are more like basically cash flowing, and you're able to buy back shares that way. This kind of self-funded growth in high quality Kaybob Duvernay oil play. And as mentioned, the pristine balance sheet with net cash flow position. So the liquids growth we can see from 2021 to 2029 timeframe is 13% compounded annual growth, and over 20% per share, which is very exciting from that perspective. Cash flow per share growth. So we get by 2029 up to $2 in cash flow per share, and I think the share price right now is about 560. So that's fairly significant opportunity there. And shareholder return, 1.8 billion free cash flow by between 2025 to 2029, and a lot of it kind of, as mentioned, being converted to buybacks, and 70% of current market cap basically in the buybacks. But between 2021 to 2024, they did something similar when they were buying back share and basically shares in delevering the balance sheet. So that's pretty good. So corporate snapshot, currently 38,500 BOEs per day, 95% liquid, a low base decline. I expect them to obviously report something similar, but I think they've been running their Leismer plant to basically the maximum there. And there's some really good data coming from Hangingstone. So when they report Q2, my personal expectation is that they could be doing in line with street expectation, and maybe even over exceeding a little bit. But the one thing that's really exciting for me personally on this slide is the basic share count. So it's 504 million, and this is really speaks to their ability to buy back shares and reduce the share count. And when you see it actually unfolding, that's really positive, right? Because you take 550, 560 now times 504 million, you get to that market cap of 2.75. But because there's cash on the books, the enterprise value is about 2.6. And now with that incremental growth, there is this embedded value for on the per flowing barrel, where they kind of, as soon as they get to the 60s per flowing, over time, as they're buying back shares, as they're reducing that market cap and inherently the enterprise value, you pull yourself towards the 50s. But the sector today, in my view, should be transacting in the higher 70s on the per flowing matrix. So that's kind of the excitement for me personally, and why I still in 2025 involved with the name. So net cash 115 million. Obviously, we need to subtract that from market cap to realize the enterprise value. Very high liquidity, but they always had that, and 305 million dollars cash on the books, which is amazing, right? So very encouraging. And from the thermal perspective, it's predictable low decline project, efficient brownfield SAGD development, Again, I really like assets or companies that develop brownfield versus greenfield, because I find there's some risk involved with developing something new from the start, and things could go wrong. But it also takes a very long time to bring the barrels online, and there's some inherent kind of geological risk that could be realized, especially if you're not near Christina Lake, where you could have heterogeneous formations, inclined hydrolithic stratifications, various clays, and non-permeable rock. So I really like the brownfield expansion in very safe kind of zones that they understand well, and obviously long reserve life for the asset. From when it comes to Duvernay Energy Corp, it's a pure play Duvernay subsidiary, self-funded flexible development, de-risk resource, and high margins. And on the product by asset side, you can see that Duvernay Energy Corp is a much smaller kind of portion of the overall production, where 38,500 BOEs per day have been produced and 98% liquids. And obviously, the 2% is the kind of gaseous composition coming from those DEC partitioning. So when it comes to the guidance for this year, thermal between 33,500 to 35,500 barrels per day. DEC is 4,000. So in aggregate, we're getting like closer to 40, right? So 40,000 for sure. I think we had the quarter where we got to 40, so that's pretty encouraging. Adjusted funds flow close to $500 million, and 50 million, 55 million in DEC. Capital 250 million speaks to the low cost of supply barrels. And free cash is much. So you spend 250 and you free cash 250. So in my view, that's a very kind of good business environment to where you're able to invest something, but then make that much, pay it back, and then some, right? So that makes a lot of sense to me. Okay, budget and guidance. So from guidance perspective, we talked about that. A thermal oil budget highlights efficient capital expansion in Leismer, progressive growth to 40,000 barrels per day. This is again on the brownfield side. It's not greenfield, so they just kind of expanding the bottlenecking, adding some new facilities to their central process facility, and kind of expanding that business to be able to handle 40,000 barrels per day. Today's facilities are not able to do that. They can't handle the emulsion that's becoming back. So you really need to invest a little bit more to get to those 40,000 barrels per day. And the competitive and resilient break-evens, when it comes to operating break-even, 32 per barrel WTI in US, and capital break-even. So if you add that extra growth, is 48 barrels, $48 per flowing WTI, so close to 50, right? So today we're at the 66, 67, and with Canadian dollar being weaker, that kind of provides that ability to generate free cash flow, as you can see, 250 million from thermal side annually. And Duvernay Energy budget highlights a multi-well pad development with focus on cost execution. So typically in this type of areas, the wells are kind of way more expensive than in thermal, and so I agree with them. They need to kind of focus on that, basically being low cost of supply, but they also want to grow to 6,000 BOEs per day by end of 2025. And so if we start adding, if you kind of looking forward and starting to understand the business, we're going to get Leismer at 40,000 barrels per day by, let's say, 2027 or so. We're going to have Hangingstone. Now it's like 8,500 or so, but I think it could easily get to 10,000. So just to simplify, we get to 50,000, and then another 6 by 2025. Maybe by 2027, it's another 4. So we have a company that's 60,000 barrels per day. And obviously with them buying back shares and able to kind of pull if the share price doesn't change, there's significant value here that's being created, where instead of getting 28,000 barrels per day in Leismer, plus 8,000 from Hangingstone, that's 36, plus 4, that's 40. You realize that additional value of 20,000 barrels per day in 3 years that's not being accounted embedded in a way or reflected in share price, because the markets are forward looking, but not that much forward looking, right? So that's kind of the opportunity. And so the chart here also shows how, based on the different oil prices, you get various adjusted funds flow, and that allows you to cover maybe base and growth expansion, but also that free cash flow for share buybacks. And it seems like here the pretty safe around 50 WTI, so that's good. But then maybe not as many shares are being bought back. But at 60, they're doing quite well, where they could generate maybe 100 million in free cash during that time frame, right? So, I mean, obviously, from a yield perspective, it's like 5%, 6%. But once you get to like 65, 66, 67, that's closer to 10% yield, which is kind of close to what everybody else is doing, I guess, in the sector right now. So, again, to speak here about the robust free cash flow profile, the business outlook, thermal assets with low base decline, Leismer brownfield to 40,000 barrels per day, Duvernay Energy enhances growth, self-funded and independent capital allocation framework, and strong balance sheet, competitive positioning. Like, you know how sometimes people say, "Oh, I have a strong balance sheet." Like, this is truly like net cash situation, right? So I believe that. And plus, from tax perspective, they have 2.2 billion in tax pools. So, and pre-payout royalty environment. So obviously those things kind of go against you sometimes when you need to pay taxes, which we all have to do, and or oil companies have to pay royalties. But we find ourselves here in a very unique situation where it's kind of like the pre-payout royalty, so it's reduced at 6% royalty rate when it comes to $70 WTI, and now it's a little bit less because we're like 66, 67. But that supercharges essentially the ability to buy even more shares, right? Where you don't have to be post payout, and not have tax pools, which they do. So the robust cash flow here that they communicate 1.8 billion in free cash flow. Again, reminder, company today trades at about 2.6, 2.7 billion. So if you generate 1.8 billion free cash flow between 2025 to 2029, we're potentially looking at the double by 2030. That's kind of them, I guess, could be the messaging here. And 100% free cash flow by shareholders. Now, this video is going to be recorded on YouTube, and in 5 years we're going to see whether that forecast was realized. But again, if oil prices even go south and not do as well, you're in you're in a cash position, right? There's little debt, and there's this big chunk of cash at 300 million. So 20% cash flow per share, CAGR, right? Compounded annual growth. And so that's kind of an exciting part about this. Now, here, I like this chart. We talked a little bit about the thermal oil funds flow, but when they compare themselves to peers, we can see Meg Energy being very low cost of supply. Athabasca is second, and Tamarack is third, Tamarack Valley. We see Navista, Headwater, obviously, right? Other companies, Strathcona is there. But all of those, they have different kind of cash flow to zero and plus capital maintenance and plus dividend, right? So in my mind, sometimes dividend, even though retirees really like dividends, this could be a little bit of a liability, because now if oil prices decline, you still need to pay a dividend. And so that creates a weird environment. But, Headwater, very low cost of supply here, as you can see, they're in the fifth place. They can pay this dividend even in very, small oil prices, like below 60 WTI, even below 55. And I think from Athabasca perspective, maybe on the cash flow to zero, they're a little bit higher than others, but maintenance capital is much lower. So they don't really, there's no need to spend a lot of cash. In fact, for Hangingstone, I think a new well hasn't been drilled up until this year, last year, for close to 9-10 years, where they only advanced 25 well pairs and they just kind of sustained them. So there was no need to spend more money. And when we look at the unique positioning, all production, what they say here, is exempt from US tariffs. So the USMCA compliant production. Now, there was a lot of speculation. Trump could easily change that, I guess, whenever he feels like it. But we do have this agreement in place, which I guess defensive in nature. 115 million in cash. We talked about that. Conservatively sized debt by 2029 maturity. I think they refinanced that debt recently at about, I think, 6.8%, something like that, if I'm not wrong. Please check if I'm wrong, but I think it's under 7% for sure. And low break evens, resilient production at 48 per flowing, capital break even, including growth, so under 50 US. So there's no danger here, kind of from that perspective, right? And no expected thermal oil-based decline in 2025. So basically, production steady, just like no decline. In SAGD, this is not atypical. Like declines are very minimal in SAGD, and especially if you're able to bring new pads online and kind of sustain that overall production on the asset. Each well individually does decline over time, but once you develop the chamber and you have the growth activity from vertical perspective, then production decline is not being realized. And let me showcase based on my little model here. You can see there is a production well, injector well, maybe infill well if they were to drill one. But when you grow the chamber and you inject steam and produce oil, there's very little incentive for anything to decline, because the more steam you inject, the more oil you produce by gravity, and that development of the chamber takes years, right? It could take 5, 6, 7 years. In their case, because they're a little bit more heterogeneous, things could be a little bit slower and drain a little bit slower, very complex geology, which, based on their new pads in the area where they develop, especially in Leismer, does not suggest that's the case, because they have very, very clean geology and very nice pays and very nice oil saturation in those areas. So I expect nothing but they're continuing in the path where each well produces maybe 1,000 barrels per day, maybe like 1,200. So that looks pretty good. And positive structural changes for Canadian heavy oil. Obviously, our differentials are a little bit narrower than previously, right? So we're in this 10, 11, $12, but not like 30 or 25 as in the past. So that could be a positive. So here they say US $10 WCS spot differential, which benefits the producers. Obviously, would love for us to be WCS to be closer to WTI, but I would take it $10 based on like historic numbers. Here we have a deeper dive into the thermal oil division, which is basically SAGD operations, right? So Hangingstone and Leismer, the two assets they have. Leismer came online in 2010, first production. Hangingstone came in 2015. I think acquiring Leismer for this company has been transformational, from Total, Equinox. And of course, the company gone through extreme transformation and a lot of, probably stresses because of oil prices. But now I think we're on the other side of this kind of realization, where you really collect the benefits of what's being advanced in the past, right? And the low kind of oil prices. But when it comes to highlights, production for those two assets is 33,500 to 35,500 barrels per day, where Hangingstone is about 8,500 out of that, and Leismer is closer to 28,000, right? So it runs at its capacity basically, and now the brownfield expanding towards 40,000 barrels per day. And the capital expenditure program is 250 million. Now, WTI operating is $32 US, and WTI with growth, as mentioned, is 48. So those are the break-evens, capital break-evens, so which support the fact that they're okay in this price environment. And the sustaining capital for 5-year average is $8 per barrel. Now, the lowest one I've ever seen was $6 per barrel, and that's Mega Energy. When it comes to reserves, you have 404 million barrels 30-year and 1.2 billion 90-year M2P reserves, reserve life index. So RLI is reserve life index. And Strathcona is trying to take out Mega Energy, and I attended the podcast in the money podcast with Amber and Adam Waters, and he talked about three things, right? He talked about reserve life index, he talked about low cost of supply, and he talked about no decline or steady production rates, right? And so here we basically see a huge example of that. You have 30 years 1P, 90 years 2P. You have basically no decline in those assets where they basically sustain for the longest time with minimal decline. And you have very low cost of supply, which is for sustaining capital, $8 per barrel is very low. And with capital, like if you brownfield, that thing is under $50 per barrel. So I just see a lot of kind of things that he communicated in this company. When it comes to future development, they do have Corner as another asset, as you can see on this map. But this is more greenfield expansion in the future for the company, and that requires significant capital. There is 40,000 barrels per day regulatory approval in place for this asset. Over 300 vertical wells have been, I think, been drilled and to understand the asset. But and 350 million barrels 2P, 520 million barrels contingent resource in place. But again, there are no facilities. There's nothing to produce to handle when it comes to surface facilities. But there's a lot of oil on the ground, which has value, significant value. And so, what this company is saying is like, is they say, look, we're good, Leismer, Hangingstone, but even if we wanted to grow further and greenfield expand, we have this opportunity with Corner, right? And this is something I've been thinking a lot about in the past, and I'm not actually sure that I want them to develop it right now or invest that capital because they really compete with other companies on that capital allocation and return of value to shareholders. And if they were allocate that capital to greenfield expansion, that will mean that money will have to come from somewhere. And where is it going to come from? Well, it's probably going to come from buying back shares, right? Or something like that, where then it gives less incentive for some investors to stay invested in the company and maybe move their money elsewhere. And so I think they're being very smart about being cautious about how they approach their greenfield expansion programs. And there's nothing I could ask more for because it's just logical, right? There's this huge opportunity, but you do need to make some kind of incentive for investors to stay. And I think things are going so well that like why to even bother? Like I guess once in a while it's okay to remind, hey, we have this asset Corner, it's great. There's amazing geology there, but whether you're going to pull the trigger on it, I don't see much benefit to do that in the upcoming years. Because also remember like that the ability to be pre-payout royalty and pay very little taxes and net back and accelerate the share buybacks while the company is cheap and trading, in my view, in discount. There's huge value in just keep buying back shares. So I think they're doing the right thing. And also like and this is something we talked about in the community in the past. Some companies they're paying dividends. Okay, well, why are you giving me money back? I don't need your money. Like you put the money back in the business, you buy back shares, you create value that way. When you give me money for dividends, I guess retirees would love that. This is great, but you're not reinvested that money. This is less money in overall enterprise value, right? So just keep it there, keep buying back shares, keep optimizing, keep reducing costs, and that's the best thing one could do. Now we're gonna do a deeper dive into Leismer, which is their most exciting asset, incredible asset, top tier oil sands project, long life reserve, 70-year current reserve life index. I mean, Adam Waters talked about RLIs and buying companies. This is precisely what it is, right? 694 million barrels 2P, 468 best contingent resource, 50-year 2P RLI, and 40,000 barrels per day. That will be the 12,000 additional to 28,000 that's currently flowing, going to be online by, I think, 2027 or so. They do have, every company says, oh, we have excellent geology. This right there, L8, right there in the upper section of that map, with the drill, it's a wonderful geology. It's very high permeability, good porosity, very clean, minimal kind of geological issues. And you can tell not because we're saying that so we can see the current production oil rates, and we can see some of those wells producing at over 1,000 barrels a day, which in my view is very exciting. So excellent reservoir underpins low corporate decline. New wells have a flat production profile for 5-7 years. You can see in this chart below here the base production, and then that sanctioned oil expansion, and the SOR, that's very steady steam to oil ratio, but you don't see a decline. You see kind of intermediate declines, but as they bring new pads online, new wells online, overall asset, you're able to sustain that production with minimal decline. And so Q1 2025 operating netback was $46 per barrel, and very low prepayout royalties of 5 to 9% until late 2027. And that's exactly why I was saying, just buy back shares, use that to your advantage, being pre-payout. Just keep buying back shares, keep developing this asset, keep growing it 40,000 barrels a day, because it's very low cost of supply, and then create that value of barrels per share, but also have least amount of shares you can possibly have by having an ongoing buyback program. So for 2025 base activity, $235 million is spent, current production at 28,000 barrels per day. Now, I don't just trust this slide, what it says, I verify by myself, and they're very close to 28,000 barrels per day. In fact, they were like producing 27,950 barrels per day, like 50 barrels like off, trying to always kind of maximize their production. It's actually very difficult to do, because when you produce the oil, you don't just produce the oil, you also produce the water. And so there's this element of water cut and, understanding your partitioning. But they've been historically been very good at that. And so kudos to the team. Pad L10, 4 previously drilled wells to support production in the second half. A little bit kind of, if you look on this map, L10 is located just west to L8, which allow a great pad there. L11 spot 6 new well pairs and flexible progressive expansion to 40,000 barrels per day. I'm very excited about this asset. I think, in my view, if you look at their current enterprise value, it's about 2.6, 2.7 billion. Well, I think this asset is probably worth more than, in 2 years, or maybe even now, depends on how the markets are forward looking, especially with cash on the books. I think this asset only is worth basically the entire current enterprise value, right? I know it's a big statement, but that's my personal view. Now, Leismer, 40,000 barrels per day progressive expansion. You can see kind of like that it's not new, right? They've been growing production from 20,000 barrels per day in 2022. Currently, we're 2025, we're 28,000. So they were able to debottleneck, brownfield expand their operations, and now we're going a little bit further. So the company has a good track record of execution, and by 2027, they should be getting towards that 40,000 barrels per day. Now, project cost is $300 million, so that's the current cash position. Incremental rate is 12,000, but if you divide those two numbers, you get 25,000 per flowing. But what we have now, we have basically Strathcona going after Meg, and in my view, the fair value for that company will be 80,000 per flowing. I'm pretty sure and convinced it's going to be probably in the high 70s. So, and if you were to calculate like what would be that value, I would say if they produce 100,000 barrels per day, so 77,000 per flowing, this will be 7.7 billion, right? 80,000 per flowing, this will be 8 billion. So, and we're not far away from there. This could be like closer to $30 per share for Meg. But in this case, the development cost is 25,000 per flowing, right? So even if Leismer trades at 50,000 per flowing, the development cost is at 25,000 per flowing. So this is good business. Like if you're able to make something for $25,000, and that value of the thing you developed is 50,000, or maybe 70,000 or 80,000, that's just good business. And what McDaniel here says in 2P NPV 10 is that they can generate 3.7 billion of value because of that incremental development on Leismer. So basically, from what's been completed, regulatory approval to 40,000 barrels per day. So the government knows they're going to do this. They're executing. No egress expansion required. Established transportation to Edmonton. So there's opportunity to move those barrels, and long lead steam generation acquired countercyclically. Talk a little bit more about that. What does it mean? Long lead steam generators acquired countercyclically. Long lead steam generators acquired countercyclically. You need steam to be injected in the steam well, like in the injector well, so then you can steam the steam chamber. And so for that, you need steam generators to do that. Now, for the incremental production, when you drill new pads, you need those steam gens, and you need more volumes of that steam so you can inject them underground. And so what they're saying is that during COVID, and I remember that very vividly, um, they bought countercyclically steam gens for very cheap because there was a seller, and they just bought them. And so now they can install them and utilize them, which I think is great. So that reduces expenses even further. When it comes to the scope, facility capacity expansion, now, if we think about SOR, let's say SOR3, right? So for SOR3, you need, let's say you produce 10,000 barrels per day additional, you need 30,000 barrels of steam to be injected to produce the 10,000 barrels of oil. And so what they say here that the facility expansion is to 130,000 barrels per day of steam generator. And if you start doing the math, so 40,000 barrels per day operation, right? So 40,000 from oil production perspective. So if you multiply by 2 with SOR2, it's 80,000. And if you multiply by 3, it's about 120,000, 130,000 when SOR is a little bit higher than 3. And that's one of the kind of feedbacks I have for people that don't believe in SOR. They think SOR is BS and it's not important. Well, if you have low SOR, um, maybe you don't need as much steam to produce those barrels of oil, right? Maybe you don't need 130,000 barrels of day of steam. Maybe you need 80 or 90. And so by needing that, you spend way more money than not needing that. And so that argument of SOR is not important. It's very silly, not only from a capital expenditure perspective, like what we just talked about, but also from operational perspective, because now when you inject more steam, that steam is condensing, and now you need to handle it at the back, so it's more volume. So you continuously struggle with that water coming back, and you treat it, and you process it, and you re-inject it, and then you generate more steam. And so that OpEx is really embedded in the business when SOR is higher. And so I find it absolutely outrageous when people say that it's not important, right? Imagine SOR 5. So if you produce 10,000 barrels per day, SOR 5, you need 50,000 barrels a day of steam, 50,000 barrels a day of steam. If you have SOR 2, you need 20,000. So you saved yourself 30,000 barrels a day of steam of being injected. So I think SOR is a very important metric. 40,000 barrels of day of bitumen processing and the scope for the facility. So that's the additional 12,000 barrels per day. 300 million project capital, 190 million CPF capital, so just for the central process facility allocation, and 110 million to drill the well pairs, to drill the pad, right? Connected to the other facilities, and basically being able to inject steam, produce oil, emulsion, gas, and treat it all at the back and re-inject the steam essentially. So everything here looks legit and really good. Hangingstone overview, man, I love Hangingstone. I think I'm like the only person that loves Hangingstone probably in the world, because most people just don't, or they just don't care. I really like their expansion on the west side of those 5 pads they have. So you can see pads AA, AB, AC, AD, and now they have like 2 well pairs they drilled. And the asset now is kind of declining, right? So over time, it's slowly declining, but it's only declining because they haven't drilled new well pairs in like maybe 9, 10 years, right? It's been always 25 well pairs since 2015 or so. And so now recently they drill new well pairs. And so current production, as you can see, project highlight is 8750 barrels per day, right, on the asset. But that's kind of restoring the decline that they've seen, where we got as low as like 7,000, 7,200 barrels per day on the asset. It has a long reserve life, 60-year reserve life, 163 million 2P reserves, close to a billion McDaniel 2P NPV10, right? For such a small asset, that's a big package, land package there of resource. and improve SOR due to field-wide NCG co-injection. So what they do, and I will use my model to demonstrate. So usually in late life, what you do, you require more steam to kind of grow the strawberry shape, the shape of the chamber. And so what they would do, they co-inject non-condensable gas, so kind of like methane, to maintain the bottom hole pressure in situ, so to limit the require of steam injection required and kind of optimize that operation. And they were able to actually a really good job on that and cut their SOR from over 5 to 3.4. So that's excellent because that's precisely what you want to do. You want to inject least amount of steam and produce most amount of oil, right? So again, this is another example that people that talk about SOR, that's not important, they're just not aligned with what this is all about, with this business model, right? SOR is a very important metric. It's not only important from a economic perspective, it's also important from environmental perspective, because if you require more energy, more steam to produce a barrel of oil, that's more energy intensive. Okay, 2025 activity, 15 million, so very low cost of supply, 2 extended reach sustaining well pairs that I just talked about, production in March, so PED AA, and initial production rates 800 to 1,000 barrels per day. So nothing wrong with that. For that asset, I think it's kind of game changing, because if you produce 7,000 barrels per day and you drill one well, but you add 800 to 1,000 barrels a day, you kind of grow it by 10, 15%, right? So maybe 20% if they drill another, maybe like an infill or some expansion there. So I think it's fairly meaningful for this little asset, and it's really cash flowing. They really position well when it comes to low pre-payout crown royalties, so about 5 to 9% into the 2030s actually. And the reason for that is because it's such a small production profile because of their facilities and such big resource that they can like it's kind of like almost like you have this big meal, but you have very small stomach. Right? Maybe there was like a operation to reduce the size of the stomach, so you can really physically put the food, as much food as you would want in, right? So this is kind of a good metaphor to what they're experiencing, because they have a lot of oil, but process facilities at surface cannot handle all of that oil, so they produce at 8,750 barrels per day daily, but they cannot really like exceed their uh, facilities kind of ceiling of what the facilities can handle essentially. So 325 million operating income generated between 2024 to 2022 to 2024, going into higher oil prices environment. That's the current. That's just over the current cash position. Q1 2025 operating netback was $38 per barrel. So the netback is $38 per barrel. That's really really good, right? And so I just see kind of more of Hangingstone doing just more of what they've done in the past. Here they have corner overview. I think it's an excellent, like I see they putting some pads, kind of like trying to show what the development could look like. Really de-risked asset, 350 million barrels of 2P, 520 million barrels contingent of resource. I think like the listener at this point, if you watch this video, if you even care at this point, you start noticing this small company has a lot of oil, a lot of geology that's underground, right? But they have process facilities that they can handle some of that oil, but they can't really scale things because that requires significant capital. And that's, I think, the challenge for Athabasca is like, how do we do this right, buy back shares, and at the same time become kind of more relevant on global scale, which they are, but not when it comes to producing barrels. And I really love that aspect about them, because most they're very unnoticeable, no debt, kind of people get more excited about like sexy things. But for me, I find this company extremely sexy when it comes to what they do, how they execute, the fact they have no debt, the fact they have all this like geology everywhere, really high RLI, so reserve life index, low decline, low cost of supply. So that's exciting for me personally. These reservoirs in Corner, they're very high quality. So 45-meter of pay initial development. And when they talk about pay, again, going back to my model, they basically talk about this, the pay here, right? So the height of the chambers. So they say we can get to 45 meters when we produce basically the oil. and grow that vertically. And so that again suggests there will be minimal, basically, decline when they start operating this asset, and there will be basically oil gushing from those wells, especially with geology being clean. And here they tell us what it is. So they tell us that there's 84% oil saturation, there's 35% porosity, and there's very high permeability at about 6.1 Darcy, which is extremely good. This is very comparable with Christina Lake asset, where effective porosity is very close. The saturation is a little bit better in the corner, but permeability, I would say, is 5 to 6 at the Christina Lake, and that's what they have here in corner as well. So pre-sanction activity, updated development plans, facility engineering study completed, funding expected to be sourced externally. Okay, this is a very key point for me here. Source externally. So is that going to be like a joint venture, some partnership in the future? I don't know. I'm not sure. So this is something to watch for. But definitely, I think I'm so aligned with their management team, because I think they're progressing this very appropriately, right? They're not being too aggressive about that. They're making plans. They're trying to kind of design for the future. At the same time, they're saying, look, we have Leismer. We're very happy with expanding that asset. We have Hangingstone, kind of brownfield expansion. Maybe not brownfield, but more like optimization, I would say. Brownfield is more Leismer. But here we have this greenfield opportunity for corner as well, if investors interested, kind of for our future plans. So there's lots of tools in the toolbox here for Athabasca. Let's talk a little bit about the Duvernay Energy Corp. So that's the other entity they have, like a subsidiary almost. Okay, so corporate snapshot. So obviously very different from the other two thermal assets, or in three thermal assets we talked about, which is Hangingstone, Leismer, and the Corner. Again, brownfield expansion, optimization, and greenfield. This is very different. This is Duvernay Energy Corp snapshot. So that's Athabasca operated. It has a 30% equity owner with Cenovus, and they suggest that they have unparalleled exposure to Kaybob Duvernay oil window. So in my view, this is an opportunity for them to really grow this asset, create this value, and because of their neighbors in the area and the way kind of Duvernay is being seen lately, maybe it's an opportunity to kind of divest that asset and in the future, and maybe reallocate that capital towards corner, or maybe further share buybacks, or maybe kind of support growth of Leismer, or maybe even Hangingstone. But in my view, this is like a great opportunity for them to really grow that asset and realize value, which is what investing is all about. So the equity ownership here is 70-30, so Athabasca Cenovus, and production right now, as we speak, is about 4,000 BOEs per day. And the reason why I say BOEs is barrels of oil equivalent, so there is some gaseous partitioning there as well. And the exit rate in 2025, they're thinking about 6,000 BOEs per day. So I think it's amazing, right? Because that tells you that the company is probably understating their production rates towards the year end, which probably will be north of 40,000 barrels a day. Now, capital is 75 million, and Q1 liquidity was 66 million. Now, they have about 200,000 gross acres, so 444 well locations, 46,000 acres of 100,000 working interest, newly operated position, and industry-leading netback, so very close to basically what Hangingstone showed us, what Leismer showed us, close to $38 per barrel in Q1. They're going to be reporting in the upcoming weeks, Q2, so I'm looking forward to see what that's going to be, this number. And the operationship of strategic infrastructure as well. Catalyst here is self-funded development within the DEC and growth to 20,000 BOEs per day, right, in the late 2020s. So then, if they're studying that now, then we see the broader view of what could unfold here. So what could happen here actually is we know Leismer going 40,000 barrels per day. Okay. Hangingstone is probably going to go to 10. Probably. It's already close to 9. So we're a couple of wells away from that going to 10. And Corner, let's say maybe it's not developed by 2030s. Let's assume no development there. So we have already 50,000 barrels per day plus 20 here. That's 70,000 barrels per day for Athabasca at 2.6 billion enterprise value. And I mean, clearly these guys know what they're doing. There's no doubt in my mind. We just need oil prices probably to stay here and maybe a little bit higher, and maybe like in that range, mid 60s, 70s, and kicking the can down the road, and everything should be fine when it comes to their plans, right? So I really like that the management team been very innovative in the way they integrate the soy assets, in the way they kind of develop their plans. I really like that. I think it's really smart. This is the map for activity for Kaybob, Duvernay Energy Kaybob. Based on the neighbors here, we can see CNRL, we can see PetroChina, White Cup, right? So White Cup is a big one with Varen right now. So that's one entity. So and they're kind of in that area, right? So that I don't want to get too imaginative about what could happen next, but I mean, looking at this map, one could see that maybe consolidation could be a very, very practical approach in the future. We have some privates there, GMT, we have Quidnock. So another thing that's kind of exciting is this whole like oil window, like liquids rich window, where you get higher partitioning maybe in a lake phase, so things like condensate maybe. So this creates even more, I think, excitement for kind of future development. And even if they don't sell these assets, and I'm not sure exactly if that's the path right now, there's lots of value to be realized. And this is kind of one of those interesting plays that's happening right now. So the development plans, we can see a very different type curve, illustration type curve below, where in those type of assets where you frac something, you get initial production there. So that profile is very different from the oil sands, right? You have this initial peak at 1,200 barrels per day, but then you have the decline in really long tail. This is not like SAGD operations. It's very different. So here you have to be kind of lucky when it comes to capturing maybe oil prices, timing that 3-6 months window, and you could be very unlucky if oil prices decline during the time frame, and now your netbacks are much less. But at 2025 activity, they have 100% working interest, operated activity, completed 3 wells pad in early fall on stream Q4, and 30% working interest in the JV activity, so 4 well pad spot in Q1 2025, on stream Q3 2025, and that's why I think they're saying, hey, our production is going to grow here, and multi-well pad spot in Q4 on stream 2026. When it comes to long-term activity, development plans to be funded within cash flow. So again, there is no necessarily free cash flow here for this entity, but they keep reinvesting and growing those barrels. I think this is the right thing to do, because that's probably the only way how they can show their neighbors the value they have on their acreage, and maybe get like premium for potential acquisition in the future. Impactful activity on the DEC, 100% working interest acreage, augmented by JV activity on DEC's 30% working interest acreage, deep drilling inventory with growth target to 20,000 BOEs per day, 75% liquids in the late 2020s. So I think if they get to that by 2030, so we're looking at, again, I'm getting repetitive here, but that's going to be a 70,000 barrel per day company, like BOEs per day company, 70,000 by 2030. Athabasca is really trying to kind of slowly behind the scenes become something important, and 2025, this video again, it's going to be on YouTube for the next 5-10 years. People are going to look back in 5 years and be like, man, this guy talked about this stuff. And I do have videos talking about this company from, I think, 3-4 years ago, something very similar. And I don't know, they're up like 5 times there, so it's intriguing what they were able to do. I mean, of course, COVID had played a huge role in the decline, and that return to basically more fair value for the company. But the problem during COVID is that they had significant debt, and there were lots of issues, because once you net back and you have debt, like, how do you pay the bills? Essentially, you lose your job, you have all these bills to pay, so you could go under. But what's really exciting about what happened with them is that they survived. They survived, and that's all they had to do. They had to survive, realize, and be really smart about kind of their future plans. So, good job, guys. Okay, so Q1 2025 results. This is just kind of quickly to summarize. In the next couple of weeks, we're going to have Q2 results. But in Q1, they reported 37.7 thousand barrels per day, 95% liquids. Cash flow was 130 million adjusted funds flow. And the netbacks 45 barrel thermal netback and 38 for Duvernay. And again, why is that 45? Is because they're brownfield expanding Leismer, right? So if they didn't do that, it will be a little bit less. Capital for 50 million thermal oil, 13 million DC. So allocating the capital, 100% return of capital via buybacks, 110 million. So 110 million divided by 5.5, we're looking at close to 20 million shares, 21 million shares in the slide here. So that's really good because you see 504 right now. We're going in towards like 480. Then in the upcoming quarters, maybe towards 450. So I really like that strategy. So value barrels per share and all that, and that's why I keep talking about this. I think that's why it's so hard for me kind of not to be part of this, because it's just like once you understand the story of what's happening here, it's very hard not to see it. And the balance sheet, obviously, it speaks for itself, where there's just net cash position at $115 million and significant liquidity, which probably they don't need. Differentiated long life reserves, we covered that a lot, guys. There's significant amount of barrels here, right? I mean, just like by looking at this DAC, Leismer, Hangingstone, Corner, you had close to 700, 800, 1.1. So over 1.1 billion in 2P. On 2P reserves, we're looking at value 3.5 billion, Hangingstone a billion, DAC under a billion, Corner just over a billion. And so once you start incorporating PDP 1.8, 3.8, 6.4, and you look the value of the company is 2.6, things get a little bit more subjective, right? I'm personally not enough value, not an asset value guy, kind of like from net asset value guy, because I believe the companies currently trade at like free cash flow slash story slash incentive slash imagination for investors to. And a good example of it is LNG, for example, right? Like at the data centers. Like, how do you know exactly? We have estimates for data centers energy utilization. We know it's going to be game changing. We know it's going to be big, but it's very hard to quantify precisely what it's going to be. And then it's very hard to say, okay, maybe some company is going to be growing their production, gas production, further into that, and therefore the price may not appreciate as much, right? So things get a little bit kind of finicky in that sense, but I really like what they're doing here, because not too many people even care about bitumen and kind of that future safe, secure, low cost of supply, low decline, low high reserve life index barrels that coming online into the 2030s. So capital utilization and hedging, long-term debt, 200 million, 300 million cash. Here they basically tell us that I was right about what I said before. 6.75% coupon issued August 2024 on 5-year term to 2029. So 6.75 on corporate rate, really good. Strong liquidity, AOC liquidity 372 million, including 289 million cash. DAC liquidity is 66 million, including 16 million cash, and facilities utilized for transportation and hedging capacity. And they have excellent exposure to commodity upside. Now, there's one kind of gold nugget there that I don't know if this is just something I just noticed just now, but I know they have WCS diff Q3 2025 at $11 diff hedge, and Q4 1,000 barrels a day at $13 hedge. But I didn't know they have WTI Q4 2025 5,000 barrels a day hedged at $70 US per barrel. I didn't know that, so that could be a positive. And when it comes to adjusted funds flow sensitivity, obviously WCS, so differentials play a huge role. WTI prices, FX exchange, and then ACO obviously plays a role, but not as important as some people think. So that's kind of the sensitivities they have, but I think they're doing just fine, as we saw on their kind of cost of supply, uh, creating free cash flow, I think close to 9-10%, something like this in this environment. But then that hedge there, WTI Q4, if we go down on 5,000 barrels per day, could be meaningful for Q4 for this company. So this is a Canadian egress outlook for kind of going into the 2030s, and with TMX expansion, the mainline addition. So there is opportunity here to just kind of keep going without differentials blowing up essentially. So positive structural changes for Canadian heavy oil. Alberta crude inventories near season lows. Trans Mountain expansion 590,000 barrels per day, and they talk about diversification of long-term market access, where you get Enbridge Express system access to Midwest PAD 2, which is the biggest PAD, right? The biggest deal ever. 10,000 barrels per day commenced in April. Keystone access to U.S. Gulf, 3,300 barrels per day currently, rising to 7,200 in 2028. And Canadian inventories, as you can see, they did rise a little bit recently, but they kind of at the bottom of their range for this time frame of 5-year time frame. So I guess there is no immediate danger to the value of Canadian bitumen. I mean, we've had some very tough moments in the last, I would say, 10-15 years, but this year it doesn't seem like it's one of those years. So at the same time, oil prices like WTI is like 65, 66. So, but if you low cost of supply, you basically collect the margin. So you should be in better shape. Valuable tax pools. So they have a tax pool summary here when it comes to 2.2 billion in tax pool. So and then they start adding kind of the value here of what it translates per share, and if we had maybe like it could be close to $1 of value. But again, things get a little bit subjective because there are different structures on how you could allocate the tax pool on the expense side, or on the what's allowed, and kind of capital or non-capital, right? At the same time, I think they have a lot of tools in the toolbox, kind of tailor the tax pools for their needs. So, but I think if somebody was to come and acquire them, they definitely look at something like this and thinking twice about, why wouldn't we pay like a premium for a company like this, especially pre-payout, especially with valuable tax pools, especially with the growth plans, very consistent buyback program. So they're in good shape. And that's what I alluded to when I talked about royalty advantage. Being pre-payout, meaning you pay less royalties. So here, this will be the blue kind of chart there, 1 to 9% royalty on gross revenue, less transportation. And once you post-payout, you go into 25 to 40% payment. So they're not there yet. And recent companies that joined the post payout is Strathcona's Lindbergh asset and Meg Energy Christina Lake asset. And so we do have out of the maybe 6-7 assets here, where pre-payout with the two pre-payout assets is Leismer and Hangingstone. So very well positioned here to kind of continuing paying less royalties into the future. Royalty structure depends on project is in pre-payout, payout, as I mentioned. They're designed to, the advantage really is not kind of selective in nature. Everybody had pre-payout status, but it really supports the recovery of the initial investment. So the government basically says, we really want you to invest in infrastructure. And by doing that for that time period where you pay out your costs on the kind of the royalty, gross revenue less transportation, we will reward you by you paying less royalties. And so Leismer remains in pre-payout stage till 2027, and Hangingstone remains a pre-payout stage over 2030. So in 5 years, and still they're going to be pre-payout. So that's a very big positive. Duvernay infrastructure, they share some infrastructure overview here for, and they have a significant owned and operated infrastructure. Of course, we've seen some deals in recent years of how companies utilize the value of that infrastructure. I don't think there is need for them to do anything right now. Just hold it. It's very valuable. They do have underutilized capacity with flexibility for future expansions. And of course, that's very interesting because they have neighbors like Whitecap and Veren, combined entity now, are very active. So that kind of creates some room for imagination what could happen there. Oil infrastructure directly connected to Pembina Peace liquid system, gas infrastructure dually connected to Pembina infrastructure and Kiera Simonet, I think it's called, facilities. So lots of kind of opportunities here in the infrastructure space. And again, I'm not even excited about that, but there's so much to be excited about here because significant value just by looking kind of um, into it without thinking too much. I'm looking at least $100 million of value just by kind of glancing over that. So, and Duvernay, Kaybob Duvernay, over 1,000 industry wells, right? So very active area. Many people are very excited about this area. We've seen some really good results lately from other companies. So lots going on over there. This is the management team. Good job, guys. Good work. Hopefully, some of you watch this video and you like it and you appreciate my thoughts on this. And again, if you guys have any questions, please contact Athabasca. I'm not affiliated with this company. I simply like them. I think they're a good company. I think they're doing a very good job. And this is my disclosure. Please like, subscribe, share with others. In 5, 6 years, people will see this and kind of look back and provide feedback, I guess. But if we currently the company is heading where it's heading, and in the next 5 years we just stay in this range for oil prices, they're probably going to do extremely well. So thank you so much for listening, and all the best.